All right, so the deal is the whole year everyone's been talking about market crash in 2021, market crash, market crash. Well, we've been saying the whole time, I don't know how many we've done of these, maybe 4 or 5 market updates. Like all of that's been clickbait. We've been proving it time and time again. The market is not crashing. I remember we made this video, we posted it on YouTube. I don't even know if I shared this with you, but got so many haters in the comments saying, oh, you guys are wrong, the market's gonna turn to crap. Well, here we are, another phenomenal real estate market with low inventory. So the first thing I want to talk about is what I'm calling like this big dilemma, okay, between buyers and sellers, because the thought right now, generally speaking in the marketplace, is that you have buyers that are saying, well, I'm sick of competing. I don't want to overpay for a house. I'm going to wait until prices drop. Well, right. I want to talk about that because the thing that they're not realizing is something I'm going to walk the audience through today, which is the only way that prices come down is if mortgage interest rates go up and inventory levels go up. So here's the example you and I talked about yesterday off air. Let's say a house right now is worth $350,000, right? Yep. And the buyer's saying, well, I don't want to pay. That house is not worth $350,000. I want to wait till this market cools off. Let's wait until that thing comes down 10%. Okay, cool. Let's look at what that actually looks like. So on a 30-year, I just looked at like 2.5% on average today. Sure. The buyer who purchases that home today at $350,000 at 2.5%, is going to pay about $147,000 in interest, okay? Over the life of the loan. Yep. That house ends up costing about $497,000, and their payment is $1,382, right? Yep. Here's what I'm having a lot of the agents that I coach talk to their clients about, and here's what waiting looks like. Let's pretend for a second, and we don't even, at least from my perspective, I don't believe home prices are going to come down 10%, right. But let's say they do. Let's say that same house is now $315K, yep. And interest rates are at 5.5%. To give some context, right? Here's what that means. This is what's insane. This is why I called you yesterday, all excited, right? Because I'm like, $315,000 at 5.5% is $328,000 in interest. Right. And that buyer who bought the home for less money that the seller got ends up paying $643,000 for the same house if they wait and buy it at a lower price. So I think I told you, I'm like, the title of this video should be like, why buying a house at a higher price is better than buying it at a lower price. Right. And so being a mortgage guy, being a finance guy, what do you make of this, and what are some of those conversations maybe you're having?
Well, I mean, so here's the thing, and you know, so I own a mortgage company, mm-hmm. right? And we're closing between 20 and 30 loans a month. So I'm down, like, these are my buyers that are out there buying these properties, and you're seeing a whole. First of all, those numbers make 100% sense. And the buyer that's buying a house right now is a very educated buyer. You're getting people that waited through college, sometimes went on and got their second level degree, like a master's degree. They're getting married, or they have a partner, boyfriends, girlfriends, all that stuff. But they're all waiting to get to a certain point where they're really set in their career. Yeah. And they're making a good amount of money. If 2 incomes at $80,000 a year is $160,000, that nets you a pretty high price on a house. So that market, the starter home is no longer like $150,000 to $200,000 home. It's this other market, right? This $300,000 to $700,000 is the new getting started number, right? Yeah. So there's a lot of income to support that. And then you go back to even after like 2008 and 9, housing starts were always lagging, right? Mm-hmm. That's like new permits to build homes. So that was lagging. So they're not building homes, so there's huge inventory. So now, like you said, we're low on inventory, and then you stack that with these rates. And what's interesting about your comparison there is that it was $150,000 more if rates go up 3%, right? Yeah. 3% more. If rates go up 1% more, it's $50,000 more, right? It's a third. Yeah. Is that safe to say?
Absolutely.
$150,000. So the house price comes down 10%, which would take a lot to have house prices back themselves up 10%. Right. So maybe your bid above ask isn't as high as it was, right? Sure. Maybe you're getting more of like the market price. So say that $350, for that to come down 10% is moving a mountain in the economic world, right?
Absolutely.
So, and then let's just say, so we listened to an update today that from Barry Habib, who's the he's like the Yoda of interest rates, right?
Yeah.
He's saying like maybe next year we see rates in the mid 3s. So to take your 2.5 and make it 3.5 down from 5.5, you're still paying $50,000 more in interest, which you can't. I always say you can't eat it or drive it.
Yeah.
You know, like it's just this interest thing you're paying the bank. So you're still $15,000, which over 30 years and 350,000, this and that, like that's not that huge of a number, but you're still better off paying today's prices at 3.5 than you are even at 4%.
Absolutely.
I mean?
Well, that's kind of my position is that, you know, in relation to like the buyer and the seller, the person right now watching this video that's saying, well, yes, Brandon, Steve, I can sell my house at a premium, but I don't want to buy a house at a premium. That thought, it took me and you looking at the analytics to not from an emotional standpoint, from a logic standpoint, to say, wait a minute, it actually does make more sense for you to get more money for your house in your pocket and buy a house maybe at a premium at a lower interest rate than it does waiting for this market to
100%.
correct and buying a house at a higher interest rate.
Right, exactly.
That's the key takeaway from this conversation so far. And
100%.
so anybody, whether you're a mortgage professional, real estate agent, buyer or seller watching this video right now, my advice is do not wait. Even if you bought a house for less money at a higher interest rate, it cost you way more money. I would rather see you give that money to the seller.
Yeah, 100%. Something else to think about too is that with the way lending is today, and especially if you have good credit, the PMI rate, so like the mortgage insurance for not putting down 20% and swapping out the mortgage that you have. You have a rate like, I'm not going to refinance because we are planning on selling. We have 3.5 or 3.25 and it's good. You're gonna swap that money out for cheaper money. And you're also going to have, by selling your house at the peak of the market, you're going to get the most amount of money in your pocket, even if you only have it for a day, right? So you sell your house and then you're going to buy the next one. That one day in there might be the most money you've ever had in your checking. Like I know for me, if I sold my house today, and I got all that equity from my house and I put that in that'd be the largest balance I've had in my checking account, right?
For sure, yeah.
So you have all that money. So now you can look at it with your mortgage person and your real estate agent and say, what's my strategy on my money that I have to put down? How much can I put down? How close can I keep my payment to the same thing? Or how much can I increase it that's still comfortable? And then take this money and invest it.
Yeah.
You know, you've got all kinds of different, you know, whether it's the cryptocurrency, these NFTs, you've got whole life insurance policies. Like you can take this time where you're getting that maximum amount of money for your house. You don't have to put all that toward the new house either.
Yeah.
You know what I mean? I mean, obviously you want to manage payment affordability and get the best terms, but on a mortgage, if you put down 20% or you put down 5% with good credit, your interest rates, your closing costs, and everything are the same.
Right.
It's just your payment that's different.
Yeah,
You know?
yeah, that's a good
So
point.
you have a way to set yourself up with this huge cushion by getting the maximum amount you can for your house now.
Yeah.
That's something to think about.
And the last thing I'll add before we move on to something else is when it comes to payment, you know, so I looked at, this is the thing I think, Steve, people don't realize because of perception. I've been talking a lot about perception these days, and like just the sales price of a house being $350.
Yeah.
Well, what I always tell and what I've taught and I've coached forever is there's only two things that matter when you're buying and selling a home, right? Monthly payment and how much you're going to bring to the table.
100%.
So the purchase price of $350 at 2.5%, the monthly payment is $1,382.
Yeah.
That same house, if it was a $315,000 at a 5.5% interest rate, the monthly payment is $1,800 or $1,788.
Right.
And when I say that to a buyer, they're like, wait a minute, say that one more time. Are you saying, Brandon, that if I wait and I got 10, 20% off this exact same house with higher interest rates, not only will I pay more in interest, but my monthly payment is higher? Absolutely 100% is what I'm saying. And not only what am I saying, it's the facts.
Right.
So let's look at the numbers for a second. So we're looking at the latest update from Redfin on Redfin's website. And this is when we remove the emotion, then we just look at the facts, right? So the first thing I want to look at is just sales prices. So all I want to look at is, we're going to look at the red, which is national, right? So the average sales price right now that we're sitting at is $376,000, right? And we look back this time last year, $327,000. That's the first thing that like people look at. Like, what are the home prices? What are home values? Values are up. You can't debate that. The next thing I want to look at is the number of home sales. The media is having a frenzy with this home sales number, because here's what I want to show you. So last month, 634,000 homes sold, and like, oh, that's so much, that's down from August, that's down from June, right? But putting that into perspective, so this time last year, 634, 667.
Right.
Here's the key thing. That's not a huge discrepancy, but the thing that people don't put into context is this next piece, which is the number of active listings. So when you look at active listings right now, and we say, okay, we've got 1.5 million listings versus 2 million listings.
Right.
So you have way less, you have 30, 40% less inventory on the market, selling almost the same amount of real estate.
Right.
This is why people, like you and I, at least my position is that as we look forward, the only thing and we've seen values level off for sure, but the only way that we're going to see this market really cool off or even point in the direction of a crash, and that's the wrong word to use, is if this number right here, Steve, shoots, like it goes way, way up, right?
Yeah.
Interest rates go way, way up. And so I don't see inventory creeping up that much because if you look at new listings month over month over month, this is a number that still declines. So you don't have a lot of people coming off the sidelines, right?
Right.
And sales aren't decreasing that much. So talk to us about interest rates and what you see in 2022.
So we're starting the, we're starting the progression up, and it's very slow and it's very cautious. We've had there's two big words that have come out lately, right? There's taper, which is regarding how the Fed is handling some of their purchases of mortgage bonds. We'll get into that in a minute. And then there's inflation, right? So one of the things that we do when there's a pandemic like we have now is the government can control the cost of money. So what they do is they buy large quantities of treasuries and they buy large quantities of mortgage-backed securities. So to the tune of like $120 billion a month or whatever. I forget what the exact number, 40 billion a month. It's at least like 40 billion a month, but it's actually a huge number. So what they're saying, what they do is they buy these bonds and they buy mortgage-backed securities. So they create a demand for them, right? So by creating a demand when a lot of people want them, you can decrease your return on these bonds because there's a big market for them, which in turn lowers the interest rates, right?
Sure.
So what the Fed's coming out and saying is, hey, we're starting to see inflation go up, right? Everybody's got a bunch of money to spend.
It's insane.
Yeah. It's like 6.2% consumer price index, right? The CPI.
Yeah.
Highest it's been in like 30 years.
Yeah,
So it's
forever.
crazy high right now. So what that means is that
maybe in our lifetime.
Yeah. I always say everybody got that COVID money. You got that money right now, right? So what the Fed does is they come back and they say, okay, so we have all these bonds on our balance sheet and we're continuing to add to it. So what we're going to do is we're going to slowly reduce the amount that we purchase. So they don't even truthfully, I shouldn't say truthfully, accurately publish how much of this they're actually buying. They're just saying we're going to slow down on buying these. So that's step one in raising rates, right? Because they're buying less of them, meaning that you need more investors to actually pay for them. For the investors to pay for them, they need a little bit better return, especially with inflation going up. They can't be getting real low returns. Otherwise, you might as well keep your cash, right?
Makes sense.
So that's the first thing that's happening. So we're starting to see those rates, but it's fragile, because everybody is still confused about father inflation over there. Is it transitory? Is it because of COVID and everybody got all their money from COVID? Whether it be like stimulus checks and things like that. Everybody's got all this money to spend. You don't have to pay your rent, all these things, right?
Sure.
So that was the big thing. They're like, inflation's coming, but it's transitory. We know it. Well, that happened, and inflation, instead of like leveling off, went up more. And we were talking about it the other day, and there's just jobs pay more now, right?
Yep.
Everybody's hiring. Jobs that last year, are paid one amount, they're making 30 to 40% more per hour or per year for some of these jobs. So people now have more money, right? And so they can pay higher amounts for things, and there's still a shortage. Getting things is still hard to do. So you can charge a premium and all those things. So higher inflation leads to the government saying, okay, we need to stop making money so cheap to borrow, increase some of these yields for people to invest in these things. So they start to slowly raise interest rates. Now, the good news is it's like the government, right? Like they can kind of control it with like a fishing pole. on how much they want to give and how much they want to reel. So they're controlling that. So, my forecast for rates, and it was reiterated in an update today, is probably looking at like the mid threes, maybe 4% by the end of next year. Is that a huge number? Not really.
No.
I mean, at the end of the day, I was looking at it like 0.3% on a $300,000 loan is like $60 a month in interest. Like it's not the end of the world, and historically it's still crazy low. But yes, rates are going to be in the threes, like well into the threes. Like if
they have to,
if you have some credit challenges, you're probably going to be looking at rates like 3 3/4. Like you might get up to like a 3.9 by the end of the year. And on the other side of that, there's a lot of talk of like another recession coming in 2023 with all this craziness we have going on now. So who really knows? That's why I say, after doing this as long as I have, whether it was when I was selling, really low adjustable rate loans, and then we had the meltdown, and we had like 8% FHA loans, and the rates went down, they went up, they go down. There's always something, so you just go back to focusing on a payment that makes sense.
That's right. And that's, I think, based on what you just said, that's why I cannot stress enough that like the person that's trying to, navigate or gamble with time just always ends up losing. The person that says, well, I'm going to wait because I think interest rates are going to go down, or I'm going to wait because I think prices will go down. I'm going to wait because I think my house is going to be worth more. Well, there's a counter argument to all of those things.
Yeah.
There's a counter argument to the seller who thinks they can get more money. Right now, prices have leveled off, and I think there's a lot of people, and I believe that we've seen the height of value, right? To your point, we've seen the floor of interest rates.
Yeah.
So waiting doesn't really serve people, in my experience.
Right.
Yeah. And so talk to me about the unemployment and the jobs report and how that affects everything, because that's a mystery that you and I talked about even this morning.
Where's the money coming from?
Where's the money coming from?
Yeah.
Why are people, not seeing, like the perception of that is that people don't want to work. There's a shortage. I mean, I was at Kroger the other night, and this was a Tuesday random night, and there was one cashier for the entire store. The line, and unless you've been to my Kroger, this won't make sense for the people listening to this.
Yeah.
But it was like wrapped around the store, and I'm like,
insane.
They're like, nobody wants to work. So from a financial perspective, what are the issues that you're seeing?
I read something funny today, and it was there's a labor shortage is the headline, right?
Yeah.
But everybody forgets the comma. There's a labor shortage for what you're willing to pay. So like there's nowadays, with the way that we've had a focus on minimum wage increases, and then so many job openings that have come from this pandemic, that a lot of people are now, you spent a whole year reflecting, so the optimist in me says people are like, I'm worth a lot more than what I was doing. Like, I'm going to go grab one of these $50,000 or $60,000 a year jobs that's remote now and do these things. So maybe those jobs there just aren't people that want to do those jobs because there's better ones, because everybody's hiring. I'll hire somebody right now.
I will too.
The right person, I'll take them.
Everybody is hiring.
Yes.
Everybody's hiring, but I just don't understand. I still can't come to grips with like why is that the case? Why are there so many employers with people that don't have people that want to work? Because I understood this when there were all these stimulus checks and unemployment bonuses. And we talked about this in one of our updates earlier this year in 2021. A lot of people were making more on unemployment and the bonuses than they were in their full-time jobs. Yeah, but that's not the case anymore.
It's gone. Right.
But so to your point is it seems like people are willing to pay more for things, but at the same time, less people are working. It's just a mystery that I'm trying to understand.
I know. It is weird, right?
Yeah.
And so, month over month, the unemployment rate is going down, right?
Okay, that's good.
The unemployment report, it hasn't been amazing, right? It's not at pre-pandemic levels, but it's getting a lot better. The other thing is that we're seeing is that first-time applications for unemployment, so people who have recently lost their jobs, is at an all-time low. It's at a pre-pandemic low. It's very, very low, which means they aren't firing people. And the people that are still on unemployment that were recently added, so I forget what the exact name for that report is also going down. So people that are losing jobs and on unemployment are re-entering the workforce.
Which is great.
You know,
so if we see an increase in employment, how does that affect what the markets do? If unemployment gets better, meaning more people are going back to work, what is the impact that has on the markets?
So if more people are earning money, right, and you're getting more money than you had, the typical American does what?
Spend
more money,
yeah.
Right? So if you're spending more money, that means you're going to support higher prices, right? So whether there's shortages, whatever it might be, you're going to support these prices. You can afford more. You can afford more groceries. You can afford this and that. So that pushes stocks higher. That pushes a lot of those different it gets away from the safer investments, which is your mortgage-backed securities and your long-term treasuries. So you start to see interest rates rise. The more money people are out there spending, the less the government needs to intervene. So they start to reel back in how much they're going to assist these interest rate markets, which is a good thing, because you can't keep rates low forever.
Absolutely.
Otherwise, if there is a recession or something happens again, you don't have a toolbox anymore.
So the impact, 100%. From a mortgage rates perspective, getting very specific, if unemployment gets better, interest rates go up. I mean, that's the correlation.
Absolutely.
Got it. All right.
Yep.
So as we look ahead into 2022, my official position on this right now, a week before Thanksgiving in 2021, is that home prices probably will level off.
Yeah.
We've probably seen the height of that.
Yeah.
I think that inventory will probably catch up a little bit, which is a good thing.
Yeah.
Getting back into more of a neutral market. I think we're nowhere near a real estate crash like the media wants us to believe. And to your point, I think interest rates have to go up in order to continue to fuel this economy for us to move forward. Yeah. What is your official take on 2022 as it relates to the real estate housing market?
I agree with all that, 100%. We've seen, all the data show, like even like the Case-Shiller numbers, which is like the gold standard for home appreciation. Mm-hmm. We're up 20% year over year, but we're up 1% from last month. We're up like 1.5% from September.
Yeah.
So like those that's showing what I've thought all along. We saw this pop, and now it's kind of leveling off at these numbers. So we're going to see these prices stay. They're just not going to climb as quickly as they were. There's another interesting data set out there, and it goes back to new construction, where the housing permits and approved permits to start building homes is down a little bit. One of the largest gaps we've ever had is the approved to build finished. That space in there is as large as it's ever been, and that's because in order for homes to get certificates of occupancy and to become real inventory, those homes need appliances that need to have chips. Those homes need to have copper, electric wires and things like that in the walls. They need to have all the low E, like fiber optic internet stuff and all that in there. And those are the things that we're having a hard time getting in our country. So you have a huge backlog of new construction homes that are just waiting on things. And you also have some of these builders that need to start turning over some of the profit to support some of the new wages that you have to have for trades, right?
Right.
So I think that as some of this new construction starts to fall in line and these homes start to be completed, that ideally we'll see a little bit of loosening of the inventory and kind of give more opportunity for people to buy and move and change their homes. But I still don't see that as being something that's going to support the housing market crashing.
Yeah, I totally agree. And I'll end it on this. This graph, to your point, is like the perfect example. Like, if you look, this is home prices, right? So if you look way back in 2015, we've just been on a steady increase, and they've been up 20, 25%. And then this right here, this little crest, has been the first time you can look at all the markets. See all these graphs? These are all the markets across the country. This is the entire United States. They've leveled off, and they're for the first time, they've gone down a little bit. And this is just a result of everything we're talking about. Yeah. So crash, I don't think so. I think we'll see another strong market in 2022. But I appreciate you jumping on the show like always, my friend.
Thanks, man.